Welcome to the Explainer. Today, we're doing something really cool. We're decoding the underlying structural language of capitalism and decision-making. A lot of people think accounting is just this boring, mechanical process, but it's really not. It's the vital, living framework that businesses use to translate their everyday operations into universal economic signals. And by the end of this Explainer, you're going to see exactly how to read these signals and interpret the true financial health of literally any enterprise. Okay, here's our roadmap for getting there. 1, the language of business. 2, who is speaking. 3, the rules of grammar. And 4, telling the financial story. Let's just dive right in. Section 1, the language of business. To kick things off, let's think about how a business actually measures its success and failure on a day-to-day basis. Every single time a product is sold, a worker is paid, or a piece of equipment is bought, an economic event happens. But how do we make sense of all that chaos? We hear about profits, margins, and market share on the news all the time, right? But what is the true underlying language that communicates this information? How do wildly different companies operating in entirely different industries speak to each other and to the public in a way that everyone can instantly understand? Well, the answer is accounting. It is exactly that language. Think of the 4 key verbs in its definition as the foundational syntax: identifying, measuring, recording, and communicating. Accounting essentially takes raw economic data and uses a highly structured vocabulary to translate it into a coherent, usable narrative for decision makers. Now, what's really interesting here is the distinct split in who is actually listening to this language. On one side, we have managerial accounting for the insiders, the managers and executives running the daily operations. But on the other side, we have financial accounting, and this speaks directly to the outside world, the investors, the creditors, and the customers. Our entire focus today is going to be on this external communication. Which brings us to Section 2, who is speaking. Before we master the grammar of this language, we kind of need to know who is actually doing the talking, because a business isn't just some vague concept. It's a very specific legal and structural organization. So the absolutely crucial point here is the massive contrast in liability. In a proprietorship or a partnership, the individual owners face unlimited risk. That means if the business owes money, the owner's personal assets are totally on the line. Yikes, right? But a corporation is completely different. It's a separate legal entity offering its shareholders a protective shield of limited liability. The absolute most you can lose is what you originally invested. And because a corporation is its own separate legal entity, it even files its very own tax return. The owners are called shareholders because, they hold shares or units of ownership in the company. A corporation can either keep these shares closely held as a private enterprise, or it can trade them publicly on a stock exchange as a publicly accountable enterprise. In these larger corporations, especially the public ones, you might have thousands of shareholders. Can you imagine thousands of people trying to manage daily operational tasks together? It would be an absolute nightmare. So instead, the shareholders elect a board of directors to represent their interests. The board sets the major policies and then delegates the day-to-day operations to the executive team. It's really an incredibly elegant chain of command. Okay, moving on to Section 3, the rules of grammar. Just like English or Mandarin or any spoken language, the language of business quickly breaks down into total chaos without strict rules of grammar. If every company just decided how to measure revenue differently on a whim, investors would have absolutely no idea who to trust. These grammatical rules are known as GAAP, Generally Accepted Accounting Principles. For publicly accountable enterprises, these are guided globally by the International Financial Reporting Standards, or IFRS. The fundamental goal here is ethics and transparency. GAAP ensures that financial reporting is complete, neutral, and entirely free from error. For this information to be deeply trusted by those external users we talked about earlier, it has to hit 6 specific qualitative benchmarks. It must be relevant to decision-making, faithfully represented, comparable to other businesses, verifiable by outside auditors, available in a timely manner, and, above all, perfectly understandable. Now, these 9 principles, you see, are the non-negotiable laws keeping our financial story grounded in reality. Take the cost principle, for example. You must record an asset at its actual original cost, not what you think it might be worth today. Or look at the matching principle, where you only expense supplies as they are actually used to generate revenue. These rules literally prevent companies from twisting the narrative. And that brings us to our final section, Section 4, telling the financial story. Once we have the vocabulary and the grammar down, we can finally publish our storybooks. In accounting, these storybooks are known as the financial statements. To see exactly how this looks in the real world, let's look at the first month of operations for a fictitious auto repair shop called Big Dog Car Works Corp. It was founded on January 1st, 2023 by Bob Baldwin, who naturally goes by Big Dog. Bob owns all the shares, and he is ready to get his hands dirty fixing some cars. This brilliantly illustrates how our financial storybooks connect. You don't just read them randomly. The ending of the income statement chapter literally drives the plot of the equity chapter, which then officially concludes in the balance sheet. They cascade into one another in a perfect logical sequence. Let's see this in action. Let's start with the income statement and see how it builds. During January, Big Dog performed repairs and recorded $10,000 in revenues. They also had to pay rent, salaries, and fuel, totaling $7,800 in expenses. By subtracting expenses from revenues, we arrive at our bottom line, a net income of $2,200. This statement basically tells us about the company's financial performance over that specific month. Now watch what happens next. That $2,200 of net income transfers directly to the second statement, the statement of changes in equity. This statement tracks what actually belongs to the shareholders. Bob decided to pay out a $200 dividend to himself from those earnings. So $2,200 in net income minus the $200 dividend leaves exactly $2,000 in retained earnings, which is the money kept in the business to help it grow. Finally, that $2,000 retained earnings figure flows straight into our third statement, the balance sheet. Unlike the income statement, which covers a period of time, the balance sheet is a perfect, frozen snapshot of the company's financial position exactly on January 31st, 2023. It proves that the company's total assets are perfectly balanced by how they were financed, through liabilities and the updated equity we just calculated. You see, by breaking it all down, it's not just math, it's a highly logical narrative. Now that you understand the underlying rules of GAAP, the different speakers in the business world, and how these highly interconnected financial statements flow from one to the next, you possess the key to analyzing any company. You now hold the keys to decode the financial health of any organization on Earth. The language of business is no longer a secret to you. So my question is, how will you use this fluency to your advantage?